Let's bring in our single best chart with Sri-Kumar. And this is the Sri-Kumar chart, folks. This was almost my chart of the year. And this is real simple. This is like the play that St. Thomas was doing on that second two-point conversion. Here's 30 years ago. Here's morning in America well above 3%. And here's the 3% mark in 1994-95. We go down here, the financial crisis, and we're way down here right now. Sri-Kumar, it is not morning in America. We're nowhere near that.
We are not, but I don't think the bond rally is by any means over, because I think we are still having the follow-up, Tom, from the financial crisis of 2008. If you have that ended, and if we are on our way back to economic growth and inflation pickup, then I would say the bond rally has ended. I don't think that to be the case. I think there are enough uncertainties which are affecting growth and inflation, which is why I think the chart, the line that you have showing, is likely to continue to go down.
Within that, in the outlier call that you have is the central bank frenzy of the last 10 days. Where are the central banks going to be, say, Labor Day of 2017?
Labor Day of 2017, let's see. Let's take the 3 or 4 major central banks. The Federal Reserve maybe hikes once this year, no more than once. So you again have this once-a-year phenomenon, which they have started 15 months ago. The European Central Bank is still in some form of easing. The Bank of England spoke about 2 years ago. Mark Carney talked about increasing interest rates. He has not done so yet. With Brexit-related uncertainty, he's unlikely to do that. Then you go over to the Bank of Japan. You have had a 25-year-long problem with stagnation. And whether it is Labor Day 2017 or Labor Day 2018, they're not going to change. And the Chinese central bank, which is the final big central bank, you're going to see some move toward increasing interest rates to dampen speculation, but they can't do too much because of the volume of debt the economy is dealing with. So if you look at today, February 6th, compared with Labor Day 2017, Tom, I don't see much of a difference.
Yeah. Sri, let me bring you over to my chart. Now, this is the correlation. I want to ask you about the correlation. In the dollar, you can see it in orange. This is the Bloomberg Dollar Index. And actually, in the white, it's not only a 10-year. It's the generic inflation index 10-year government bond yield. How do the two correlate?
I think in terms of the correlation, you have seen the bond yield rise since the Trump election. And you have seen also, at least until 6 weeks ago, we saw the dollar strengthening as well. What you have now is that the bond yield has been coming down a little bit, and so has been the weakness of the dollar. As I look forward, I see the correlation essentially being broken, Francine, because with the amount of uncertainties that you have in the world, the dollar strengthens again. But I think the correlation is broken in that the yield comes down also.
Right. And Sri, I want to let you know, Bill Gross just published his monthly letter, and he agrees with Sri-Kumar. He talks about the methadone of quantitative easing.